Hey, what's going on, traders? Thank you for watching while I discuss why I prefer to trade options over straight shares of stock and what exactly an option is. But before we dive in, I apologize for the watermark. I am currently using a trial version of this editing software, and I don't want to purchase it unless I actually get a following. I will purchase the full version of the software once we hit 100 subscribers. That being said, help me out and hit that subscribe button, like, comment, and share with your buddies this video and the channel. Now let's hit 100 subscribers and let's get it. Alright, so an option contract is an agreement between a buyer and a seller. An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. And on the other side of that, an option seller has the obligation, meaning it has to buy or sell an underlying asset at a specific price on or before a certain date. And an option is just like a stock or bond. It is a security and a binding contract with strictly defined terms and properties. The easiest way to explain this is to use the purchasing a house example. So let's say you find your dream home for $200,000, but you currently don't have the money for it. You go to the seller and you enter in an agreement to purchase the house at its current market value, which is $200,000. And in order to lock in that $200,000 purchase, you pay the seller $3,000 for the right to buy the house at $200,000 anytime over the next 3 months. So what you're basically doing is you're paying the seller $3,000 to reserve the right to buy it at $200,000, regardless of what happens. So after 1 month, after you went into agreement to purchase the house for $200,000, oil is found on the land, skyrocketing the value of the house up to $1 million. And of course, the seller's like, heck yeah, I want to sell this house for $1 million now. But he can't because he's in a legal obligation to sell you the house for $200,000. And so in that example, you could buy the house for $200,000, giving you a profit of $797,000. And that is calculated by, you have the $1 million value of the house, minus the $200,000 that you bought it for, and minus the $3,000 that it cost for you to buy the agreement to buy the house for $200,000. All right, now here's an example of using a call option in terms of buying a stock. So here you have a chart, and we'll say that right here you buy 10 call option contracts, which is the value of 1,000 shares at the $70 strike price, anticipating that the value of the stock will go up. The option price was $2 per contract, so I total you $2,000 to get in the trade. The next day, boom, it skyrockets up. Currently, you have 10 call option contracts with a strike of 70, and now the current value of the stock is 84. So now you have the right to exercise your option, which means the seller has the obligation to sell you the stock for $70 when it's currently at 84. So 84 minus 70 minus the $2,000 at the cost of the options equals $12,000 in profit. All right, so does that make sense? So you have the option to buy it at $70, and then it shot up to 84. And if you exercise that right to get the 1,000 shares at 70 when it's valued at 84, that is a $14 difference. So you times it by 1,000. That's where you'll get $14,000, and then you minus the $2,000 that it cost you to get in the position, giving you $12,000. All right, here's a different scenario. Say you didn't find oil on the land where the house was located. So the same house is located on the beach, and a hurricane hits the city and destroys your house. Since you only have the right to buy as a buyer under the agreement, you do not have to purchase the now destroyed dream home that you had. So that will leave you with a $3,000 loss because you want to buy the house that's destroyed. So unfortunately, you do have to walk away, but you are not obligated to buy it for that $200,000. All right, now I'm going to use this as an example when it comes to using options. All right, so here's another stock. It's going up, and you buy 10 call option contracts with the strike price at 105, anticipating the price is going to go up in value. And the price of each contract was $2, so once again, this trade cost you $2,000 to get into the trade. And then the next day, boom, it gaps down to 101. losing you $4. So the stock went the opposite way that you were predicting. With a $105 strike price, the option is now worthless. You would not want to exercise your right to purchase a stock at 105 when the stock's at 101, because if you did purchase it, you're buying an automatic loss. So therefore, you can just walk away and take your $2,000 loss and find another trade. Now, why I trade options over trading stocks? Hands down, the number one reason is the risk control. The risk is defined and it can't be deviated from a predetermined risk if done correctly. So say a stock that I pay $500 into a trade, and it's a long call or put, then that's the max I could lose. There is no ifs, ands, or buts, and I'll give examples of that later on. And then you can also make profits in a sideways market as well. Say when you buy shares, you need a price to go up or down. But with options, you could also make a high probability sideways trade as well. And you can control more shares with less upfront capital. And once again, I'll give another example of that. And then if you wanted to, you actually don't even need to use a stop loss if you position size correctly. All right, here's an example of the defined risk I was talking about, which is why I enjoy trading options over shares. So if you're trading shares, say you bought 1,000 shares at $114. You're going to need upfront $114,000 to enter that trade to buy the shares. And you also, realistically have $114,000 at risk, regardless if you have a stop loss or not, because stocks can gap overnight. And then once again, like I said, you bought 1,000 shares at $114, risking $114,000 total. The next morning, the stock gaps down to 98, hitting your stop loss, and you just lost $16,000. Now, with options, say you bought 10 contracts, which is equivalent to 1,000 shares, with 114 strike price for $2 a contract, you risked $2,000 for that trade. Same scenario, say the next morning gaps down to $98. All you lost was $2,000. That's it. You didn't lose $16,000. All you lost was the $2,000. And that is the main reason why I enjoy trading options. Not only enjoy, but also prefer. That's all I have for you guys and gals. Thank you very much for watching. And like I said, I'm very sorry about the watermark. Let's get those subscriber numbers up to 100 and I will make it disappear really fast because I find it very annoying as well. If you have any questions or advice, please put them in the comment section. I'll be sure to get right to them, and thank you very much.